This course explains your basic responsibilities under the Bank Secrecy Act and your obligation to be alert for and report large currency transactions, suspicious activities, and other reportable transactions. We'll also cover customer identification requirements, new account openings, and the importance of a strong Customer Identification Program, CIP. This is part 1 of 2. In it, we'll focus on basic BSA compliance, suspicious transactions, some tactics used by money launderers, and a few key forms and records. Our focus in this course is the same as the Bank Secrecy Act's 2 primary concerns: money laundering and suspicious activities. Money laundering is the attempt to conceal the source of illegally gained funds by processing them through legal businesses and the banking system to make the money appear to be legitimate.
So, how long you been out of jail?
2 weeks. So how's this little operation of yours work?
Like a charm. Here's the setup. We make some nickels and dimes from our self-service car washes. And lots of dirty cash from selling these. Little rub-a-dub-dub. The money goes right into our legitimate bank account.
How do we do that without attracting the feds? You know, they use the banks to help them focus in on operations like this all the time. You know, a 10 grand deposit triggers a report sent to the government. I ain't ready to go back to the pen.
Relax. We make lots of small deposits. Some we make in person. We use the ATM, the night depository. We have more than one account. Bank is not going to suspect a thing. Besides, we're good customers.
Money laundering is an often complex process that doesn't necessarily involve currency, but nearly always involves 3 basic steps which may be going on at the same time. Placement. The money launderer places unlawful proceeds into the financial system through deposits or other means. By following the reporting and record-keeping requirements outlined in this course, you can help detect money laundering at this critical stage in the process. Layering. The money launderer separates the proceeds of criminal activity from their origin by using layers of complex financial transactions. And integration. The money launderer uses additional transactions to create the appearance of legality through the purchase of assets. Can you see how your position as a financial services provider places you in an ideal position to spot, block, and report money laundering and other suspicious financial activities? That's why we've created this course and why you're taking it. We must take our roles in the war against crime and terror with the utmost seriousness. Passed in 1970, the Bank Secrecy Act is the law and our weapon in that war. It helps us know what to watch out for, informs our daily procedures, and guides us through various situations we may encounter. A fundamental objective of the Bank Secrecy Act is to provide a paper trail with which to help detect and convict money laundering criminals. You and your institution help create this paper trail by being on the lookout for suspicious activities and reporting certain currency transactions. The 9/11 attacks of 2001 forced Congress to recognize the relationship between terrorism and money laundering, and to pass amendments to the BSA that seek to shut off the flow of funds to terrorists and their organizations. These additional amendments include the barring of shell banks from the U.S. financial system, giving the Secretary of the Treasury the authority to bar or otherwise regulate the use of accounts that temporarily commingle funds in one place before paying them out or transferring them to other accounts. The establishment of minimum anti-money laundering programs in financial institutions. The amendments also imposed stronger customer identification procedures, reports concerning certain international transactions, application of increased due diligence to private banking accounts for foreigners and to correspondent banking accounts with foreign banks, and revisions to suspicious activity reporting rules. Money laundering is the theme of this first lesson. We'll focus on the basics of BSA compliance with anti-money laundering regulations, how to spot suspicious transactions, and a look at the specialized forms used in reporting on currency transactions. Depository institutions like yours are required to carry out 4 key compliance activities to support anti-money laundering efforts. Report any currency transactions over $10,000 by or on behalf of one person in a single day to the feds. Report suspicious activity on a timely basis. Keep records of checks, cashier's checks, money orders, and traveler's checks bought with $3,000 to $10,000 in currency. That's an inclusive range, meaning no less than $3,000 and no more than $10,000. And follow the rules for exempting customers from currency transaction reporting. We'll concentrate a bit on these activities. Currency transaction reporting is up first. If your institution has knowledge of any currency transaction or series of currency transactions in a single day, by or on behalf of one person, totaling more than $10,000, the transaction or transactions must be reported to the federal government. The form used for this is called a Currency Transaction Report, CTR. Much more on CTRs later in Lesson 2. The BSA defines a transaction as any deposit, withdrawal, exchange, U.S. dollars for U.S. dollars, or exchanges of U.S. dollars and foreign currency, and any payment or transfer of funds by, through, or to the institution. Currency, of course, is the physical manifestation of actual money, cash, paper, or coin, not including checks or other written order not involving physical money. A series of transactions for the BSA means multiple transactions totaling more than $10,000 in a single business day into or out of a single account, or multiple accounts owned by a single entity. Deposits made at night, over a weekend, or during a holiday are treated as if received on the next business day following the deposit. When considering multiple transactions, aggregate cash-in and cash-out amounts separately. Currency exchanges should be aggregated separately with each of the cash-in and cash-out totals. I'll give you 3 examples of how this works. Suppose a person deposits $11,000 in currency to his savings account and withdraws $12,000 in currency from his checking account. You would complete the CTR as cash in $11,000, cash out $12,000. This is because there are 2 reportable transactions. You may, however, file a single CTR reflecting both. Now, let's say a person deposits $6,000 in currency to his savings account and withdraws $4,000 in currency from his checking account, and he presents $5,000 in currency to be exchanged for the equivalent in euros. You would complete the CTR as cash in $11,000 for the deposit and the cash for the exchange, and no entry for cash out, because the currency exchange is aggregated with each of the cash in and the cash out amounts. The result is a reportable $11,000 cash-in transaction. The total cash-out is $9,000, which doesn't meet the reporting threshold. One more example might be of a person depositing $6,000 cash in her savings account and withdrawing $7,000 cash from her checking account. In addition, she presents $5,000 cash to be exchanged for the equivalent in pesos. You'd report $11,000 cash in and $12,000 cash out. Again, because the currency exchange is aggregated with each of the cash in and cash out amounts, the totals for both of which exceed the $10,000 reporting threshold. Computer accounting usually catches aggregate transactions, but if you know that a customer has made a series of transactions totaling more than $10,000 in a single day, even if you didn't process these transactions, you have the responsibility of making sure a report is filed. Follow your institution's procedures for making it happen. Law requires your institution to report suspicious activities on a timely basis because they may be signs of money laundering, terrorist activity, or other crimes. For their part, the Bank Secrecy Act is no secret to money launderers. They actively look for ways to get around the reporting requirements. Purposely arranging transactions to evade reporting requirements is known as structuring. It's illegal, by the way, for you to help someone structure a transaction to avoid required reporting. There are generally 3 ways to structure transactions. One is to make numerous currency deposits, none of which go over the $10,000 cutoff for a required currency transaction report. Some money launderers try to get around the $10,000 limit by making multiple deposits to a single account in a single day, but at different branches of an institution. Their hope is that no one will spot the aggregated transactions totaling more than $10,000. Another structuring method is to use currency to make numerous purchases of certain monetary instruments in amounts under the reporting requirements. The instruments are then deposited in other accounts and transferred to yet another. Sometimes the launderer will hire a number of couriers known as Smurfs. Each Smurf purchases several monetary instruments under the $10,000 reporting limit and deposits them in one or more accounts. Usually the funds are then transferred to a foreign account. Criminals frequently need to exchange small bills for large ones, which are more convenient to handle. BSA-savvy launderers know they can exchange money without triggering a currency transaction report, as long as they keep their transactions under $10,000. Another money laundering tactic is the use of front companies. These are businesses that appear to be legitimate with perfectly legal sources of income, but they have a dark side too. Money launderers funnel their ill-gotten funds through them, claiming the money came from the business's supposedly legitimate functions. You may encounter any number of other suspicious transactions besides those I've just mentioned, including some that may be evidence of terrorist activities. The key to recognizing many suspicious transactions is to consider them in the context of normal banking activities. For example, a business customer may make transactions that don't fit the normal pattern for other similar businesses. A regular customer may suddenly begin making transactions that don't resemble their usual account activities. In other cases, a customer will make seemingly normal transactions, but something makes you question the legitimacy of his or her business or source of funds. A person could be involved in any number of activities that, alone or in combination, may or may not indicate a terrorist connection. For example, a person might have lots of cash but no apparent occupation, have a small business but not seem concerned about profit, make numerous currency transactions under reporting limits, or repeatedly use money orders. These activities could apply to traditional money laundering as easily as terrorism. A couple more examples of potentially suspicious activity that may or may not be more indicative of terrorism are someone making transactions with known terrorist havens or countries with terrorist connections, and transactions such as wire transfers by a person on a student visa who doesn't appear to be going to school. Your institution's Customer Due Diligence (CDD) program will help you spot suspicious transactions. It should be designed to determine the identities of customers as part of your institution's Customer Identification Program (CIP), determine customers' normal and expected transactions, determine customers' sources of funds, including information on types of instruments typically used, and monitor transactions on an ongoing basis. While the CIP procedures address the opening of accounts, the CDD procedures address the ongoing monitoring of transactions and existing accounts for suspicious transactions. The CDD should also help you maintain procedures to identify beneficial owners of an account. According to FinCEN,
heightened risks can arise with respect to beneficial owners of accounts because nominal account holders can enable individuals and business entities to conceal the identity of the true owner of assets or property derived from or associated with criminal activity. With respect to accounts that have been identified by an institution's CDD procedures as posing a heightened risk, these accounts should be subjected to enhanced due diligence that is reasonably designed to enable compliance with the requirements of the BSA.
Under FinCEN's regulations, a covered financial institution must also establish and maintain a due diligence program that includes policies, procedures, and controls reasonably designed to detect and report known or suspected money laundering or suspicious activity conducted through or involving private banking accounts. FinCEN is the financial crimes enforcement network of the Department of the Treasury. To combat structured transactions and the financing of terrorist activities, the Bank Secrecy Act contains provisions for reporting suspicious activities. All financial institutions operating in the United States are required to file a Suspicious Activity Report, SAR, whenever they encounter suspected illegal activities that meet certain reporting thresholds. Later in Lesson 2, we'll discuss the nitty-gritties of SARs. But say, for example, you're approached by someone wanting to exchange a large number of small denomination bills for larger ones. They don't have an account with your institution and, for whatever reason, are unable to present any form of identification. You've just been faced with two red flags. The unwillingness to present or lack of any form of identification is one. The other is the huge amount of small bills to be exchanged. And it's not a business customer conducting a typical transaction. That's red flag number 2. Some institutions have specific policies for dealing with this type of situation, like requiring identification be presented for any currency transaction. In general, you should immediately notify your supervisor if you suspect someone of money laundering. In any case, it's important that you do not fill out a SAR in front of the person. You must never disclose the fact that a SAR is being or has been filed, or share information about it with the subject. Decline any such request and notify FinCEN. Nor should you disclose SAR-related information to anyone who has no need to know the information. You may, however, share SAR reports with your parent company and affiliates who are also subject to SAR rules. Follow your internal policies and procedures for sharing reports with entities within your corporate structure. Here's what should happen if you suspect criminal activity. Again, report it to your supervisor. Your institution should file a SAR with FinCEN if a suspicious transaction or series of transactions involve $5,000 or more in funds or other assets. You can, in fact, file a SAR to report any transaction you believe might be relevant to a possible violation of any law or regulation. Your institution is also required to file a SAR to report transactions that may be related to terrorism against the United States, insider abuse involving any amount of money, violations aggregating $5,000 or more where a suspect can be identified, a suspicious transaction or series of transactions aggregating $25,000 or more if no suspect has been identified, transactions aggregating $5,000 or more that involve potential money laundering or violations of the Bank Secrecy Act. If a reportable suspicious activity requires immediate attention, your institution should telephone an appropriate law enforcement authority. FinCEN also maintains a financial institution's hotline for reporting suspicious transactions you suspect may be related to terrorist activity. 1-866-556-3974 is operational 7 days a week, 24 hours a day. Even if you notify FinCEN by hotline, your institution is still required to file a SAR ASAP. And if a transaction is in excess of $10,000 in currency, your institution must file both a CTR and a SAR. Note, however, that CTRs should not be filed for suspicious transactions involving $10,000 or less in currency, or to note that a transaction of more than $10,000 is suspicious. If a transaction is suspicious and in excess of $10,000 in currency, then file both reports. While we're on the topic of suspicious activities, let's take a sidelong look at OFAC and fraud. OFAC is the Office of Foreign Assets Control. It's an agency within the U.S. Treasury Department. It administers laws that prohibit financial institutions, insurance, and other companies from doing business with certain countries, individuals, or entities. These laws also impose economic sanctions against hostile targets. The intention is to disrupt U.S. enemies' finances and make it more difficult for them to operate. OFAC maintains a list of individuals and entities restricted from trading in the U.S. It's called the Alphabetical Listing of All Blocked Persons, Specially Designated Nationals, Specially Designated Terrorists, and Specially Designated Narcotics Traffickers. Its shorthand reference is the SDN list. Persons on the SDN list can include individuals, corporations, partnerships, and other entities. Your supervisor can give you the details on how your institution screens for persons on the SDN list. OFAC compliance is critical. Lives can be lost if terrorists and other criminals are able to operate because their funds aren't blocked as required. Civil and criminal penalties can be imposed for OFAC violations. Other BVS courses cover OFAC in more detail. As for fraud, it's an intentional deceit, trickery used to get another person to part with something of value. Losses from fraud and embezzlement amount to hundreds of millions of dollars every year in the U.S. Keep in mind that a swindler is seldom someone who has been an account holder for a number of years. The first 3 months after a new account is opened are at high risk for fraudulent activity, and that criminals like to avoid calling attention to themselves. The more average they look, the better their chances for success. Popular forms of bank-related fraud include forged, altered, and counterfeit checks, altered and counterfeit currency, forged, altered, and counterfeit financial instruments, stolen, altered, and counterfeit credit or debit cards, split deposit schemes, check kiting operations, and other con games. If you're responsible for processing ATM transactions, you've got an especially challenging task to detect and prevent fraud. ATM swindles are increasing in frequency, largely because the swindlers may never appear in person before an institution employee. This makes them more brazen and willing to try scams. One type of ATM fraud involves fake faceplates called skimmers that criminals attach to ATM card slots. Skimmers read the card's magnetic stripe. If a criminal combines this with a hidden camera to get a PIN, it's possible to copy the cards and use the PIN to make withdrawals from customers' accounts. Con artists often pick busy times to attempt a swindle. Their goal is to hurry, embarrass, upset, or intimidate you. But the basic rule of follow institutional procedures provides a good foundation for foiling those efforts. Properly identify the individual you are serving and follow your institution's procedures to reduce your chances of being victimized. Let's spend some time now on forms and records. The 4 most frequently used forms you must use to comply with the BSA are the Currency Transaction Report, Suspicious Activity Report, Currency or Monetary Instrument Report, and the monetary instrument records used by your institution. Recall that the CTR is used to report each currency transaction or series of transactions in a single day by or on behalf of one person totaling more than $10,000. This applies to one person with one account, several persons with the same account, and one person with several accounts. Currency deposits, along with other cash-in transactions, are considered separately from withdrawals and other cash-out transactions. So cash-in transactions and cash-out transactions must separately total more than $10,000 in one day before they must be included in a CTR. Thus, if an individual makes $7,000 in cash deposits and $5,000 in cash withdrawals in the same day, no CTR is required. But if that individual also makes a $6,000 currency exchange, that amount is aggregated separately with deposits and withdrawals, and a CTR will need to be filed for both cash in and cash out. CTRs must be filed electronically and submitted by the 15th day after the day of the transaction or transactions. The SAR form you use to report criminal or suspicious activities, including suspected money laundering and terrorist activities, may be filed even if the transactions don't fall within the reporting requirements of other forms. Remember that the reporting of suspected criminal activity is best done in consultation with your institution's legal counsel. The Currency or Monetary Instrument Report, CMIR, is used to report the transportation of more than $10,000 in currency and certain monetary instruments into or out of the United States. Your institution should be keeping its own monetary instrument records of purchases of $3,000 to $10,000 in currency. Whether a customer buys the same or different instrument simultaneously or makes multiple purchases in a single day, if the purchases involve from $3,000 to $10,000 in currency, a record must be made. If the currency involved exceeds $10,000, a CTR must be filed. FinCEN requires most BSA forms to be filed electronically, using its BSA e-file system. You can find details and copies of most of these forms in the BVS Compliance Center. The law also requires annual reports to the IRS on persons who own an interest in or who have authority over a financial account in a foreign country that has at any point during the calendar year an aggregate value exceeding $10,000. The BSA also requires that you keep records regarding certain transfers and transmittals of funds, such as wire transfers, in the amount of $3,000 or more. Some transfers, though, are exempt from the rules, including transfers between one person's accounts within the same institution. Also exempt are 1. Transfers in which the originator and beneficiary are any of the following: banking institutions, wholly owned domestic subsidiaries of banking institutions chartered in the U.S., brokers or dealers in securities, wholly owned domestic subsidiaries of brokers or dealers in securities, the federal government, state or local governments, or federal, state, or local government agencies or instrumentalities. And 2. Funds transfers governed by the Electronic Fund Transfer Act of 1978, as well as any other funds transfers made through an automated clearinghouse, ACH, or an ATM or point-of-sale system. However, NACHA, the Electronic Payments Association, imposes rules for the transmission of payments received from or transmitted outside the United States. Following these rules allows institutions to identify international ACH payments and perform the required due diligence. If your institution participates in the ACH network, you may receive or be asked to transmit an international ACH payment. If so, you obtain and transmit the same information required under the BSA for wire transfers, transmittals, no matter the amount of the payment. The information required for those transactions of $3,000 or more that aren't exempt depends on what role your institution plays in the transfer and the relationship of the parties to your institution. If the originator is an established customer, records must be retrievable by the originator's name, and if a customer of the institution, account number. Information you must retain about the originator's payment order includes the originator's name and address, the payment order amount, the execution date of the payment order, payment instructions received from the originator, the identity of the beneficiary's institution, and as many of the following items as are received with the payment order: the beneficiary's name and address, the account number of the beneficiary, any other specific beneficiary identifier. Allow me to clarify the meaning of established customer. This would be a customer you know well, someone who's been banking with you for some time. A non-established customer, then, is someone you don't know well and who hasn't held an account with your institution for all that long. Well, anyway, it confused me when I first heard it. There's additional information to record if a payment order is placed by an originator who is not an established customer. This is because transactions by non-established customers pose a much greater risk. The records required depend on whether the payment order is made in person or not made in person. If you know the person placing the payment order is not the originator, record the originator's taxpayer identification number, TIN. If no TIN is available, record the originator's alien identification number or passport number and country of issuance, if known by the person placing the order, or note that no number was available. If a payment order is made in person by a non-established customer, before accepting the order, you must verify the person's identity. If you accept the order, you have to retain a record of the person's name and address, the type of identification reviewed, the number of the identification document, for example, a driver's license number, the person's TIN, a social security or employer identification number, for example. If no TIN is available, you must record an alien identification number or passport number and country of issuance, or note that no number was available. If a payment order your institution accepts isn't made in person, you must record the name, address, and TIN of the person placing the order. If no TIN is available, record an alien identification or passport number and country of issuance, or note that no number was available. The institution also must retain a copy or record of the payment method for the funds transfer. If the beneficiary is an established customer, records also have to include the beneficiary's account number. For each payment it accepts as the beneficiary's institution, your institution must retain the original, a copy, or an electronic record of the payment order. The beneficiary's institution must also retain certain records if the proceeds are delivered in person. It must verify the identity of the person receiving the proceeds and retain a record of the person's name and address, the type of identification reviewed, the number of the identification document, for example, a driver's license number, the person's taxpayer identification number, TIN, for example, a Social Security or employer identification number. If the person doesn't have a TIN, the institution must record an alien ID or passport number and country of issuance, or note that no number was available. When delivering the proceeds to a person who is not the beneficiary, for example, when the beneficiary is a corporation and the proceeds are delivered to an employee of the corporation, the beneficiary's institution must follow the steps just mentioned and retain a record of the beneficiary's name and address and the beneficiary's TIN if known by the person receiving the proceeds. If the beneficiary does not have a TIN, the institution must record an alien ID or passport number and country of issuance, if known by the person receiving the proceeds, or note that a number was not available. If the proceeds are delivered other than in person, the beneficiary's institution must retain a copy of the check or other instrument used to make payment, or note the information contained on the instrument. It also must retain the name and address of the person to whom the payment was sent. Summarize Lesson 1. Basics of BSA compliance. You're required to carry out 4 key compliance activities to support anti-money laundering efforts. Report currency transactions, single or a series, totaling more than $10,000 in a single day. Report suspicious activity. Keep records of financial instrument purchases with $3,000 to $10,000 inclusive in currency. Comply with rules for designating customers as exempt from BSA currency transaction reporting requirements. Money laundering and suspicious activities. Money launderers and terrorists are familiar with BSA reporting requirements and apply structuring tactics to stay under the $10,000 reporting threshold, and/or they use front companies through which to funnel their ill-gotten booty. The key to recognizing many suspicious transactions is to consider them in the context of normal banking activities. Your customer due diligence and customer identification programs should help with this. Suspicious transactions. You're required to file a Suspicious Activity Report, SAR, with FinCEN whenever you suspect illegal activities that meet the reporting thresholds. Specifically, you must file when a transaction or series of transactions involves $5,000 or more in funds or other assets. A transaction or series of transactions aggregating $25,000 or more if no suspect has been identified. You suspect insider abuse. When you encounter a match on FinCEN's SDN list. And you must file both a CTR and SAR when a transaction or series of transactions are in excess of $10,000 in currency. Fraud is all about trickery and deceit. Keep in mind that swindlers haven't held an account for very long. An account's first 3 months are at highest risk of fraud, and that criminals like to hide in plain sight by looking average. Key forms and records. The 4 most frequently used forms you must use to comply with the BSA are the Currency Transaction Report, Suspicious Activity Report, Currency or Monetary Instrument Report, and the monetary instrument records used by your institution. Some funds transfers are exempt from reporting requirements. Whether or not and what information is required to be recorded depends on who the originator and beneficiary are, what their relationship is to your institution, and the role it plays in the transaction. I look forward to seeing you in Part 2 of Bank Secrecy and Money Laundering.